Okay, good morning, good afternoon, and good evening to everyone that is joining us from around the world. My name is William Blackman. I'm an Associate Director for Consumer Protection at Innovations for Poverty Action, or IPA. A kind welcome to our session, Protecting Consumers in the Digital Finance Era, Insights from New Global Survey Data. Digital financial services are transforming access to finance in low and middle income countries. But with this growth comes risk, hidden costs, fraud, over-indebtedness, and limited recourse when things do go wrong. Today, we'll be exploring new survey evidence on these consumer risks and discuss what it means for both policy and practice. We'll start today with insights from the World Bank's 2024 Global Findex, presented by Dr. Dorothy Singer, who will share highlights on consumer capability and confidence. I will then share preliminary results from IPA's Financial Consumer Protection Survey, followed by a panel discussion. Dorothy, I will pass it over to you, and I will start sharing your slides. Okay, Dorothy, over to you.
Thank you very much, William. Good morning, good afternoon, good evening to everyone joining. It's my pleasure to share with you today some of the data from the Global Findex database 2025 on financial inclusion, but particularly on gaps in financial capabilities and confidence. Financial inclusion is a cornerstone of development, and since 2011, the Global Findex database has really been the definitive source of information on how adults around the world use financial services. So many of you in the audience are probably familiar with the Global Findex database, but for those of you who might not be as familiar with the database, let me just say a couple of words on the motivation and methodology behind the data we collect as part of the Global Findex database. So since 2011, the Global Findex is not just the first, but also the only comprehensive source of global demand-side data on financial inclusion in 140 countries around the world. Data has since been collected in 4 additional rounds in 2014, 17, 21, and 24. We're able to do this work thanks to funding from the Bill and Melinda Gates Foundation, as well as more recently, the MasterCard Foundation. Our database measures how adults around the world manage money, make and receive payments, save, borrow, mitigate financial risks. And here today, I'll show you some of the data we have on financial capabilities and confidence. So I should note that we don't have a dedicated module on that, as well as in 2024, new indicators on phone ownership and internet use. And I'll show you one of the indicators on that today. Our data is nationally representative, and as such, we can also provide metrics for specific groups, such as women, rural residents, and poor adults, because we collect the data at the individual level. And this data is really there to track global policy and progress on improving financial inclusion, and in the context of this session, of course, advancing financial consumer protection and capabilities. Next. So let me start off with showing you some of the data we have on account ownership, which is really our measure of financial inclusion before getting into financial capabilities. Next. Account ownership rates around the world vary widely, but we can also see that the map has gotten a lot darker over the years, which, the darker color indicates higher account ownership. Next. What we see that global account ownership has increased from 51% to 79% between 2011 and 2024. And as you can see, much of this increase has been driven by the increase in account ownership in low and middle income countries. Next. When we just look at low and middle income economies around the world, we see that 75% of adults own a financial account in 2024. The data here is broken down by region. As you can see, there's a bit of variation across regions, as you would expect. You can also see that when we measure account ownership, we really ask 2 separate questions. We ask whether people have an account at a bank or similar financial institution, or whether people have a mobile money account. And so the way this breaks down here is that if you have only a bank or similar financial institution account, respondents show up in the blue part of the bar. If they have both a bank and a similar financial institution account and a mobile money account, you're in the purple part of the bar. And if people have only a mobile money account, they're in the pink part of the bar. So, for example, in sub Saharan Africa, you see that in 2024, 40% of adults have a mobile money account in 2024, including 20% who have only a mobile money account. And that becomes important in a couple of slides because the way we ask questions is sometimes we only ask them of people who have a mobile money account, sometimes we ask them of people who have a bank account. Next. So let's get to some of the data we have on gaps in financial capabilities and confidence. And first here, next, I want to show you some of the data from our new connectivity module. In particular, I want to show you data where we asked respondents whether they received a spam call or a text message in the past year, and if they did so, whether they sent money to the scammer. So what we see overall in low and middle income economies, 19% of mobile phone owners tell us they have been exposed to scams, but very few say they actually lost any money to scammers. Now, those numbers are notably a lot higher in Latin America and the Caribbean, as well as in sub Saharan Africa, where about 30% of adults tell us they've been exposed to scams. But of course, there's also variation at the country level, as you can see here in the figure, which shows select economies in sub Saharan Africa, where the share of adults who tell us they've been exposed to scams ranges from over 50% of adults in Tanzania to about 10% in Nigeria and even fewer in Lesotho. Next. We also have some data on more, I guess, traditional financial capability and confidence question. And here we have data showing that, unexpected fees, for example, suggest that some adults are financially vulnerable. And the first data point we have on that is that about 5% of adults who tell us they're paid a government wage payment or a private sector wage payment into an account, 5% of those adults tell us they paid higher than expected fees when they tried to collect their money from the account it's been paid into. Now, of course, we don't know whether this indicates that people are just not aware of fees that may be associated with, having an account and so on, or whether that's a reflection of excess fees being charged to a consumer. But in any case, I think this provides some evidence that there's either a potential lack of understanding of a fee structure or a lack of transparency or potentially exploitative behavior on the on part of the payment distributor. Next. Similarly, we have also data on erroneous transactions that people do and which may suggest that adults, can be financially vulnerable. And here we look specifically at mobile money accounts, where we asked adults who have a mobile money account if they've ever sent money to a wrong number, and then if they did so, if they ever got the money back. So when we just look at sub-Saharan Africa here, for example, we see that nearly 1 in 4 mobile money account owners have sent money to the wrong recipient, and only about half of them got the money back. And now that's, of course, important because in order to be confident and trust that the financial services you use, serve you and function as they should, you want to make sure that, the money you have there goes to the right recipient, but also that if it you can get it back if you made a mistake, and there is a recourse option here. Next. Perhaps, more importantly, we also see that see evidence in our data that some adults rely on others to transact on their behalf, suggesting really a lack of financial capability on some of the adults. And here we ask a question only in South Asia, I should note, about adults who receive a government payment into an account in the past year and how they access this government payment once it's in their account. And here in South Asia, about 1 in 5 adults tell us that 1 in 5 of adults who receive such a payment, I should note, that they rely on others, such as a family member, to collect this money. Now, this suggests, of course, a lack of financial capabilities because ideally, if you have an account, you're able to transact on that by your own. Next. One of the big themes we have in the most recent edition of the Global Findex database is that mobile technology is really driving not just financial inclusion, but also the use of accounts and digital payments. And here we see that digital technology really also provides opportunities to enable greater financial confidence. And what I mean by that is that digital channels allow users easily to either check their account balance, easily on their phone or computer, or receive information about account balances on their mobile phone or computer. And so when we look at it overall, we see that about 40% of adults with an account at a bank or similar financial institution have received such information, suggesting that by regularly, we have research basically suggesting that when adults can check in real time their balances, this can help them build greater trust in that the money is in their account, it's there, it's available if they need it, and also trust builds trust basically in the use of financial services overall. Next. Of course, financial confidence is not only important for adults who have an account and use financial services, it's also important to understand financial confidence among adults who currently don't use financial services. Because the indicator is, of course, if you're not confident in your use of financial services and you currently don't use them, you're probably less likely to start using financial services. And here we have data showing that about 2/3 of adults who currently don't have an account at a bank or similar financial institution in low and middle income countries tell us that they don't feel confident using an account if they were to open that. So let me stop here and maybe just a quick note that our report and all our data is publicly available. So if you're interested to learn more about our data, please visit our website. But over to you, William. Thank you.
Wonderful. Thank you, Dorothy, so much for this really insightful presentation and really exciting to be able to look at this new Findex data and these new indicators that have been added. And I think that my work, IPA's work that I'll be sharing now, and I think you can see my screen, really complements the findings from the Global Findex. So I'm glad that we're able to share both of these at the same time. As I had mentioned, IPA has our own financial consumer protection survey, which is a multi-year, multi-country effort to better understand the risks that consumers are facing when using digital financial services. This is one of the first times that we'll be sharing any of this data. Our reports will be coming out shortly, but this is a bit of a sneak peek to be sharing right now. From new results from our data collection that happened earlier this year. Just very briefly on IPA, or Innovations for Poverty Action, we are a global research and policy nonprofit working in over 20 countries to reduce poverty through the generation of rigorous evidence. Our goal is to create strong evidence, share it strategically, as we're doing now, and then equip decision makers to be able to use it so that solutions that work can be used to improve lives at scale. Okay, so an introduction to the financial consumer protection surveys that I'll be talking about today. These are, as I mentioned, large-scale surveys run across 10 countries designed to understand the real world risks that people face when using digital financial services. Our focus is on 4 key areas: pricing transparency, over-indebtedness, fraud, and the redress process. Our goal is to help regulators and providers build safer, more inclusive markets. Today, we'll be presenting early results from Kenya, Nigeria, the Philippines, Tanzania, and Uganda. Results will be coming out soon from Bangladesh, Ethiopia, India, Indonesia, and Pakistan early next year. We'll also be running another round of data collection in 2027 to be able to measure some changes over time. So we have a lot of results, and this is a quick look at some of the top risks that we see across country. And we do see important variation across countries, as you can see here. But there are, I would say, 3 types of risks that stand out as perhaps the most problematic across countries. We see that poor service reliability, fraud, and lack of transparency seem to be really core issues across all countries. In Tanzania, for example, 86% of users reported a fraud attempt in the past 12 months in our data, which really echoes the findings from the Findex. We also see that network issues are the most reported challenge in the Philippines, Uganda, and Nigeria. We see that unclear fees and difficulty with mobile apps are also quite common. Although the use of digital credit varies quite widely by country, default rates among those that are using digital credit are quite high, particularly in the East African markets included in our survey. I'm going to start by exploring price transparency and issues around consumer choice. Across all of the 5 countries included in our survey results today, consumers are not comparing prices consistently before choosing an agent, a loan, or a payment account. Even in the best cases, barely half of users are shopping around, meaning that people are often selecting products or services without knowing whether they're paying more than they really should be. Similarly, roughly half of consumers know the fee for a transaction before they send money or make a payment. This is relatively consistent across countries, and it means that that transparency is still quite limited. Many people are learning what they paid only after they paid it, which undermines trust and informed choice. Next, to credit-related issues. We see that debt stress is quite widespread, especially in Kenya and Uganda, where over 60% of borrowers report missing a payment in the past year. Many are also reporting that they've had to cut back on food spending to repay a loan, or they regret taking on a debt after taking one on. Next, to fraud. Falling prey to fraud or scams seems to be relatively common from our data. What we see in our survey results is that between 6 and 14% of consumers report having actually lost money due to fraud in the past 12 months. Rates of exposure, of course, are much higher, and they show much more variation, from just 20% of consumers in the Philippines reporting any exposure to fraud, regardless of whether they fell prey to that fraud or not, to 86% in Tanzania. This may represent some difficulty in precisely measuring fraud exposure through demand-side surveys. It's a bit hard for consumers to know when they were exposed to fraud if they didn't fall prey to it. Our survey instrument was somewhat different in Nigeria, meaning that we're not able to separate rates of fraud exposure from rates of actual fraud losses, but we know that 23% reported some, at least, exposure to fraud. We can very roughly estimate the total aggregate country-level losses due to fraud. Fraud losses per incident are actually remarkably consistent across countries, with the median loss typically about 30 USD and the mean about 100 USD, skewed by a few, relatively large losses. If if we use the mean loss per incident and estimates of the total annual loss rate, the number of the proportion of people that report having lost any money due to fraud, along with the total number of DFS consumers per country, we can generate rough approximations of the total annual aggregate losses per country. So our estimates range from 108 million USD in Tanzania to 431 million USD in Kenya. So these losses are quite substantial when you look at the national level. I'll spend a moment on the experience with DFS agents and specifically issues of discrimination. We see here that discrimination reports are highest in Uganda and the Philippines, and they're much lower in Tanzania, perhaps reflecting Tanzania's strong national identity around unity, where people may be less inclined to describe poor treatment as discrimination. Again, in Nigeria, our survey instrument was a bit different, meaning that we didn't ask directly about discrimination, but 7% of consumers did report being treated disrespectfully by an agent in the past year. I'll now move on to the complaints redress process. I think these Sankey diagrams are pretty nice in visualizing the consumer experience when seeking redress. So here what we're looking at is consumers that experienced a significant issue, in this case, losing money due to fraud. And what we see is that 2/3 of these consumers that experienced a real substantial issue didn't pursue any formal complaint. This remains true even when consumers believe that the provider should be liable to compensate them for their losses. And then among those that do make complaints, only about 1 in 4 are satisfied with the outcome. So this means that overall, about 8% of those that lost money to fraud sought redress and then were satisfied with the outcome of that redress, meaning 9 in 10 either didn't seek redress or were unhappy with the redress process. Now, this matters. Effective redress is an important consumer right in itself, certainly, but it also impacts financial inclusion goals. When consumers have a bad redress experience, they're much more likely to reduce or stop using digital financial services. As we can see here, reductions in usage are much higher when consumers are dissatisfied with the redress experience. This is shown in the green bars, as compared with those consumers that are satisfied with the redress experience, shown in the purple bars. So just to say it again, across all of our countries, we see that dissatisfaction is consistently associated with lower usage rates, showing that a weak complaint system is not just frustrating users, it's also eroding trust in the market and ultimately reducing usage. So I will wrap up there as well. As I mentioned at the beginning, these are very preliminary results, and we're quite excited to be launching the formal reports and data quite soon. Both the data and reports from earlier rounds of data collection in 2020 and 2021 are available on our website. You can follow the QR code or follow the link. We also have our 2024 Nigeria survey data and report available online. We'll be putting out results from the countries that I just shared today, the Philippines, Kenya, Tanzania, and Uganda, very soon. Next year, we'll be adding the additional countries where data collection is currently ongoing. We'll also be producing a cross-country report that will be available online shortly. So thank you again. Let me stop my sharing. So thank you, Dorothy, for her presentation. I hope both IPA's evidence and the World Bank's evidence is useful and insightful. I'd like to spend the rest of today's session focused on a discussion with an esteemed set of panelists. I'm really quite privileged to be joined by a panel of experts who are bringing diverse perspectives from research and policy, regulation, industry. You've already heard from Dr. Dorothy Singer, who's a senior economist at the World Bank, and whose work on Global Findex helps sort of set the global baseline for financial inclusion and consumer protection. We'll also hear from Dr. Aisha Isa Olatinwo, who leads the Consumer Protection and Financial Inclusion Department at the Central Bank of Nigeria. She's really helping to shape one of the more dynamic regulatory environments in that region. We're also joined by Kennedy Kimboy, who is the Public Policy and Advocacy Director for mobile money at GSMA. He's bringing really deep experience on how the private sector can align commercial incentives with consumer outcomes. Finally, we're joined by Dr. Francis Anand, who's an assistant professor at the University of California at Berkeley. And his research really explores the financial markets and consumer behavior in emerging economies. So welcome to you all. Thank you for joining us. I'll dive right into the first question, which I'll direct at Dorothy. The Findex data that you shared today suggests that lack of financial confidence and capability can harm take-up of formal financial products. Our IPA survey data suggests something similar, that consumer protection failures, including ineffective redress experiences, reduce use of financial services. So how do you see these two findings fitting together? And what does the Findex evidence add to our understanding of how consumer capabilities and consumer protection impact sustained financial inclusion?
Thank you, William. Yes, I mean, as you already mentioned as well, I think I see those surveys really as complementary, right? I mean, I think the Global Findex obviously is a very broad survey. We cover a lot of uh, breadth. Basically, we cover 140 countries around the world, and as a result of that, we need questions that basically, work everywhere. And so, and as a result of that, we cannot provide the deep dive that other surveys, such as your survey in a financial consumer protection space can really provide. And I think in that sense, as you mentioned, I think Global Findex can kind of provide and set the stage on kind of like big themes we see overall, and then it's really up to individual surveys such as yours to provide a more deep dive into specific topics, right? As I mentioned in my presentation as well, right? We don't have a dedicated consumer protection module because was not really the goal of the Global Findex survey. But I think, the questions we do ask, I think kind of really nicely complement and show some of the common themes that you then are able to pick up in more depth. And that's, around unexpected fees, which you identify as, a main concern across many markets, as well as really fraud, right? So we have that. What we cannot ask in Global Findex is around questions around over-indebtedness and that. So those are often very country specific. So we leave that to more country specific surveys there. And so I think the messages that come out of our data are really, and maybe going in reverse order from what I presented, is really thanks to the Global Findex data, we know that 1.3 billion adults around the world remain unbanked, right? And when we ask the unbanked, why don't you use financial services? I think nearly 2/3 of them telling us that they don't know if they would be confident using financial services. That's obviously a big hurdle. Aside from all of the other reasons we know why people don't use financial services, be that cost, lack of identification, and so on. But just people telling us that, I don't know if I could use them, I think that's a big hurdle as well. And so if you think about bringing people into the financial system in the first place, I think we need to think about basically financial literacy training at a very broad level, making sure that people understand how to use financial services. But at the same time, I think it's also up to the industry basically to design financial products that are really tailored to the needs and are easy to understand, uh, right? And then I think the second part of that is then obviously once people have and use financial services, right? They need to be confident in their abilities to, and capabilities to use them, right? If you have a financial service, but you're like, ooh, but like in case I make a mistake, for example, and send a mobile money payment to the wrong number, right? Is there a redress mechanism there? Like, mistakes happens, right? But if I make a mistake, is that money just lost forever? And if that's the case, then, maybe people over time who might be prone to making errors are like, maybe I don't feel as confident using that product, because if something goes wrong, I don't have a redress mechanism, right? And so I think this is where it plays really, into the interplay of, financial confidence and capabilities, and then use of the financial services. I mean, and use is obviously very important, because financial inclusion by itself is not the goal, right? The goal is really for people to use financial services in order to benefit from the advantages that come from using financial services, such as having a safe place to store money, making payments conveniently and fast, and so on. But that can only happen when people are confident in their financial capabilities. And I think the Global Findex data provides some data points where we see that that's not true across the point. And I think there's definitely room for improvements in terms of both providing education around the use of financial services, but also designing systems, be that from the industry side as well as from the regulator side, to make sure that, for example, like fee structures are transparent and clear, right? But also educating uh, consumers around that. And then I think the other thing that I think we can show is that digital technology also offers opportunities for people to build financial confidence and capabilities, right? Increasingly, people access their accounts, be that a mobile money account or their bank account, through an app on their phone, right? Including in low and middle income countries, where we see that over half of account owners access their account through a digitally enabled methodology. But at the same time, right, I mean, it provides a great opportunity for people to check their balances, get notifications from their financial service provider, and so on, to stay up to date on, movements in their accounts and information. But we also see that currently only 40% of account owners, use those opportunities, right? And so I think there's also still room for further improvement there. And so I think overall, kind of like addressing issues in terms of financial confidence and capabilities is really important for further expanding financial inclusion, both on kind of bringing people into the system, but also making sure that people use financial services once they have them uh, to the best of their ability and the most benefit. Thank you.
Wonderful. Thank you for all of that. In the interest of time, I will keep us moving along. It's super interesting comments. Dr. Aisha, I will move to you, and I'm really interested to hear from a regulator's perspective how this type of survey evidence, either Findex data from World Bank or IPA's work on the consumer protection surveys, how this type of survey evidence fits into regulator, in your case, CBN's broader set of tools that you use to monitor the market, the Nigerian market for consumer risks.
Thank you very much. Good afternoon once again, or good morning. As a regulator, in fact, our key mandate is the supervision of the financial sector. And while in doing that, we normally will issue policies, framework, guidelines to help all the participants, that's the operator, to know what to do at every particular time. And so surveys like this helps us to form part of the information that we build into policy. And as you know, policies are not stagnant. You can develop new policies, you can amend or modify an existing policies. It helps us also to understand consumer perspective, and which is very critical. I think it's also one of the reasons the Consumer Protection Department was created. Prior to the creation of that department, the banking supervision, which is the primary supervisory department for the banks or the other fintechs, do all of this, not really focusing on key customer issue. But with this Global Findex figure or survey, we're able to see that, yes, we bring customers into the system, or we encourage them under the financial inclusion framework to come into the banking system, but somewhat they are exposed to some risk, some sometimes knowingly, because sometimes customers also do compromise their financial details. But that is why information like this helps us to know the area where the major issues are and to also treat the root cause analysis. So this way we're able to, this can feed into the financial literacy, consumer education, or is it even the issue around the institutions offering those products? Because I saw one of the presentations saying there you have the network issue is still high in Nigeria. I think this is a very focal point because, of course, if network issue is high, transactions will continue to drop off. That's this complexity in reconciliation. So consumers or customers of the banks are debited, but the funds don't reach intended beneficiary. So all of this will help us to know which the percentage will now help us to drive our energy, to know where we should drive energy and focus, and also what kind of policies to use in moderating those risk factor. Because a major focus for us is confidence and trust in the system. And if you don't have that, no matter what framework you put in place, you continue to see large number of customers coming into the system, but the account becomes dormant. I'm also happy that Nigeria is showcasing high volume volume in terms of mobile telephony accounts. A lot of effort went into that, including licensing the subsidiaries of the telcos. We also took some study to Kenya, Safaricom in particular, just to learn what other jurisdictions have done better. All of these have helped us to understand. Okay, so bringing to par the numbers of the populace holding phone and ease of access to brick and mortar branches. So that was why we're able to divert focus, create policy around tiering of KYC so that there is not requiring the same KYC level for all or categories of customers. So that way, for tier one, you don't need to even visit, or you can open a tier one wallet and still get basic banking operations. But the issue now is when we see the fraud is not moderating, because I can see Nigeria is showcasing one of the highest in terms of consumer exposure to fraud. So that keeps us focused. In fact, we have the central switch, that's the Nigeria Interbank Settlement System, helping to drive the industry collation of fraud and drill down to the exact issue. So we can check if it's a policy requirement or a sanction requirement, because sometimes you can have all of the policies, but if the operators are not complying with it, then it means then that you need to use the stick approach. So in our regulation, we have also defined proper or clear sanction for violation. And my department is actually focused on ensuring that we continuously provide education and literacy or information to customers on how to ensure that they do not succumb to those fraud risk or fraud exposure. Let me stop so in time for the want of time. Thank you.
Thank you so much, Dr. Aisha. This is super compelling to hear all of the great work that CBN is doing to address the issues that are being raised through these surveys, and I'm glad to hear that this survey evidence is useful as you determine sort of where to focus your energies. Kennedy, I want to turn to you next as our representative from an industry association. So we know that mobile money operators, other financial service providers face competing pressures. delivering profits to shareholders while protecting consumers from harm. So from your perspective, where do you see that these incentives do align, where interventions to protect consumers also make good business sense for providers? If you can share any examples from your experience, that would be fantastic.
Yes, I mean, thank you, William. And it's really good to be here to be part of this very important conversation. And I'll just delve into first of all, some of the numbers just to be able to contextualize, how big the industry is. So currently, the industry has about 2.1 billion registered customers and close to around 500 million active accounts. And this is something we've seen over the years, that it's an industry that keeps growing. Just being able to demonstrate the huge value that mobile money is really playing in terms of driving financial inclusion. One of the areas, particularly around consumer protection, that we are seeing good impact, particularly in terms of driving usage and adoption, is obviously around affordability. And the issue of affordability, it's really a it's a double-edged sword. And what do I mean by this? While of course the industry has been very proactive in trying to, be innovative around pricing, mobile money services, some of the challenges we witness in some countries is majorly around, taxation policies. And in many cases, some of the taxation policies that we witnessed are really sector specific, and in most cases are not quite aligned with financial inclusion objectives. Now, what am I really leading to here is the point really is, while of course we've seen a very positive correlation in terms of affordability and driving adoption, some of these policies, if not well aligned with financial inclusion objectives, would deter, obviously mobile money users from using services. And of course, that now means going back to informality and all that. And so there's really need to be able to look at regulatory, alignment here, in terms of coherence, in terms of, some of the policies that different governments are coming up with, to be able to ensure that there's alignment on some of these things. On this particular issue, I will continue to emphasize that I think this is really one area where, if perfectly handled, would be able to unlock a lot of growth. But closely to it is, of course, is the issue of fraud, because money is about trust. And if a consumer doesn't trust a platform, they would rather not use it. I mean, that cuts across even in this room. You would never put money where you will not trust it to be. And so particularly after COVID, around 2021, we saw an increase in digital payments. And with it, of course, it came with various challenges in terms of cybersecurity, and considering also the profile of people who use mobile money services. And on this, one area that we have seen lots of positive impact is just around collaboration to be able to mitigate fraud. And when I talk about collaboration, it's collaboration between the different private sector players, the different service providers, cutting across obviously fintech players, mobile money providers, traditional players such as banks, coming together to be able to address some of the fraud incidences, such as SIM swap fraud, which is very common, particularly in Africa, and being able to come up with a solution and to be able to drive that adoption. But then again, there's also another form of collaboration that is also very interesting, which is also collaboration amongst regulators themselves. Obviously, the mandate of mobile money is with central banks and financial regulators. But when you look at how fraud is operating within the mobile money sector, sometimes it cuts across the ICT connectivity aspects of the industry, which means some of the solutions would have to come from telco regulators that come working together with financial regulators. And where we are seeing both parties working together, we are seeing improvements in fraud cases going lower and lower. And of course, that also means adoption. But in the interest of time, allow me to also just quickly touch on a very important issue of law enforcement, because whenever we have issues of fraud, it might always mean that maybe there's loss of money. We did a study at the GSMA to try and understand, some of the ways the industry is supported to mitigate fraud. And in this particular research, we noted that most of our members, actually 96% of them, do report cases of fraud to law enforcement officers. But 71% of the ones who report these issues are of the opinion that law enforcement officers are not efficient in combating mobile money fraud. A good example mentioned here is whenever money is sent to a wrong number, sending mobile money to a wrong number account, in most cases, the laws would actually require the customer to actually reach out to law enforcement officers to try and get their money back. And this cuts across even the banking sector. But unfortunately, when you narrow down to some of these issues, law enforcement officers are not actually technically empowered to be able to resolve such issues. And if unlocked, would actually resolve a lot of issues. Yes, William.
Wonderful. So sorry to interrupt. Thank you so much for this. I know that we are just at time, and I want to make sure that Francis has a moment to speak as well. So let me just, if we're allowed to go over for 2 or 3 minutes, I'll ask Francis to step in and talk about his experience as a researcher. And basically, the question, Francis, for you is, how do you make use of this survey data, Findex, IPA data, to complement the work that you do as a researcher?
Well, thanks a lot, Willie, and of course, Dorothy, for the wonderful presentation. I thought a lot was going on, and hopefully folks have been thinking of what you presented. I think this session is overall great, so it's totally fine if I don't get a chance to speak, because I think Kennedy and Dr. Aisha and everyone has been quite remarkable in all their presentations. But I want to spend, since we're out of time, just the next minute or two, just to highlight a few things related to your question, Willie. So I guess, the way I think of, the usefulness of, surveys that are coming out from you and from the World Bank through Findex, I think it's really outstanding and motivating in what kind of questions to focus on, right? Really, I think economics today has become so wonderful in thinking of really what we call doing economics that matters, precisely because of data, right? The first starting point as a researcher, you want to ask yourself, what should I even be studying, right? What is the big question? What are those big stylized facts really that we should be thinking about, right, as a society? So I think in many ways, Findex and IPA, Digital Financial Service, user surveys actually, serves as, if you want, the building blocks, right, of thinking of really what kind of questions even researchers should be thinking about. Here be thinking of new issues that are very distinct, right, from adoption to usage to welfare issues to quality of services, to risks that consumers face. Very new, really thinking, really new set of questions, really, I imagine, this space that economists can spend time thinking about. So that's number one, really what to really focus on or what to do research on, right? That's number one. I guess the second part is related to really thinking more broadly about the relevance of, in many cases, we do very small scale, localized, typical RCT style, research, which has been questioned for so many years, in terms of external validity, right, of a lot of the evidence. But, to the extent that we can compare, RCT localized facts or estimates, right, to this, if you want, more representative, in the language of Dorothy, more representative national surveys in terms of sample facts, actually allows us to make a lot of progress, right? More distinctively, if we want to think of external validity of the specific problem or question that researchers are thinking about here. And I guess the list goes on and on and on, but I want to conclude by saying that, even beyond RCTs, right, which is kind of one of the classic approaches that we have seen development research evolve in recent years, I think even thinking hard about quasi-experimental studies, right? We'll draw a lot on some of these surveys that you've been collecting systematically or longitudinally over time. One of the famous one in my mind is my colleague Nicola at Bocconi's work on trying to understand interoperability, right? The two-side kind of this double-edged effects of interoperability. On one hand, it reduces prices because it increases competition, but on the other hand, actually it creates negative impacts on financial inclusion or access. Why? Because business becomes no longer worthwhile for firms, right, to operate in places that are very thin, like poor places. So anyways, amazingly, Nicola and his co-authors were able to draw on Findex, right, to be able to establish this fact. So anyways, last point, I think, next time we should probably call this session, market protection rather than consumer protection. Because what we are seeing, obviously, is that it turns out, for example, fraud is not just just widespread and very common, but it's very inefficient to the market. Everyone in the market is harmed just because of the existence of, for example, vendor fraud, right? So in many ways, once you eliminate the fraud, you fix the problem for the consumer, but you also fix it for the firm, right? Very large way, like really like the question. So really, consumer protection in my mind is about market protection. So just to be able to make it clear that, it's kind of a double dividend approach to thinking of maximizing welfare. So I'll stop here. I know we don't have too much time. There's so much to say, but I hope we get a chance to talk again. Thanks a lot.
Wonderful. Thank you, Francis. And thank you, Dr. Aisha Kennedy, Dr. Dorothy. Thank you all for the really engaging conversation and useful insights. Thanks to anyone that was able to stay over. Apologies for taking us 5 minutes over time. I think we could spend another hour on this easily. It's quite a broad topic and lots to say on this topic. I'm also sorry we weren't able to get to some of the questions raised by the audience, but we'll be sure to follow up separately to address those. So thank you for raising those questions. And thank you again for participating in this session. Have a good afternoon, evening, morning.
Thank you.
Thank
Bye-bye.
you.
Thank you all.
Take care, everybody.